Not long ago, blitzscaling was Silicon Valley's favorite party trick. Spend billions today, worry about profits tomorrow, and hope dominance arrived before reality did. It created Ubers, WeWorks, and some spectacular flameouts in between. Here in 2025, that party is over. In a high-interest world, the cost of money itself has become the buzzkill. And if you're budgeting, investing, or saving, the same rules apply. What worked when money was cheap no longer works when every dollar is expensive. The question is, can companies still reach those billion-dollar heights under these rules? Or is the game now completely different? From overnight unicorns to disappearing acts. It wasn't too long ago that hitting a billion-dollar valuation felt almost mythic. Startups that managed it in only a few years were talked about, as if they had uncovered a secret formula no one else had cracked. A young company could launch with a loose idea, raise oceans of cash from investors eager to buy into the hype, and find itself labeled a unicorn before even working out the details of what it was actually selling. Speed was the benchmark. The shorter the time to $1 billion, the louder the applause. That race defined the culture. But in 2025, the stopwatch has slowed. Stretching across 5 or even 10 years to reach unicorn status is no longer treated as failure, it's expected. This shift isn't just about investors running out of patience. It speaks to the end of a particular economic era. In the late 2010s, companies like Uber and WeWork came to symbolize growth at any price. They gorged on cheap capital, piled up staggering losses, and reassured audiences that a flood of users today would somehow justify profits tomorrow. The logic was, climb high and fast, and the market will eventually reshape itself to your business. Reality told a different story. Many of those poster children of blitzscaling have since stumbled or collapsed outright. Startup Genome reported that global ecosystem value actually dropped after the pandemic, and underlined that the old pace of unicorn creation was never permanent. Investors and customers now meet each fresh billion-dollar headline with skepticism instead of awe. Back then, the culture rewarded story over substance. A persuasive pitch deck full of exponential growth charts often unlocked hundreds of millions, regardless of whether customers were paying anything at all. Founders weren't expected to prove much beyond momentum. But because financial discipline was shoved aside, the valuations were often built on weak ground. That's why companies once described as market-defining disruptors now look like cautionary tales. The very structure that allowed them to succeed so quickly has become the reason many dissolved just as fast. The environment today favors a different profile. Movement may be slower, but it's also sturdier. Startups spend more years grinding upward, not sprinting. Borrowing costs force management teams to plan carefully and prove that their unit economics can stand up to scrutiny. The test now is whether a startup can carry the weight of higher interest rates while continuing to move forward. That's endurance, not spectacle. The culture has adjusted accordingly. Founders focus on stretching timelines, pacing growth, and emphasizing resilience over rapid conquest. The mindset among younger founders reflects this new reality. Instead of promising world domination in 5 years, pitch decks are loaded with detailed spreadsheets on customer acquisition costs, churn rates, and interest rate scenarios. Investors ask sharper questions, and vague assurances no longer pass as strategy. Growth is still celebrated, but only when it lines up with financial fundamentals. A startup that manages to break $1 billion in this environment is often 8 or 10 years into its journey, having survived greater scrutiny and pressure. Consider the delivery services of the last decade. Many of them soared to unicorn valuations thanks mostly to subsidized orders and endless investor cash. The story was that everyone would soon be eating through their platform, so losses never mattered. If those same companies were raising today, every additional user would be dissected for contribution margin, and the investor reaction would stall if the math didn't add up. Instead of sprinting to billion-dollar valuations in a few years, they'd need to tread carefully through several funding rounds, adjusting to higher costs of money and lower tolerance for losses. That is the new baseline. The psychology of spending underlines the transformation. When money was nearly free, each dollar invested felt light and disposable. Now, each dollar carries weight, tied to higher borrowing costs and real consequences. Overspending in today's climate means taking on a debt load that investors know could cripple survival. So instead of 10 or 20 new unicorns every quarter, we see just a handful over the course of a year. Ambition hasn't died, but ambition without a sturdy path to revenue gets filtered out immediately. This slower cycle also reshapes how the outside world perceives unicorns. The old flood of new billion-dollar companies often felt inflated, with too many names handed the same label regardless of durability. That diluted the term unicorn into little more than a PR hook. By contrast, achieving unicorn status in 2025 feels like an earned milestone. Each one carries credibility, since fewer survive the tests of profitability and long-term value creation. The rarity restores some of the mystique that the word once had. Success, then, is less about dazzling acceleration and more about durability. Investors evaluate whether a company can still stand after years of rising rates, shifting capital flows, and tighter cash management. The once idealized sprint is no longer rewarded. What matters is whether the company stays upright instead of burning out like a comet. The financial wreckage left behind by WeWork and other blitzscalers serves as a blueprint of what not to repeat. And in an environment defined by more expensive money, those lessons influence every investment discussion. The culture among founders reflects this shift as well. A decade ago, bragging about the fastest trip to unicorn status was treated like a badge of honor. Today, the proud announcements are about reaching break-even earlier than expected, surviving multiple funding rounds without crippling dilution, or proving actual profitability before chasing huge valuations. Ironically, a company that claims rapid unicorn status today sometimes faces suspicion. Speed suggests that shortcuts may have been taken. The markers of prestige have inverted, with slower but steadier trajectories valued more highly. The numbers back this up. In 2021, almost 600 new unicorns appeared globally. By 2022, that figure had fallen to just 359, a 40% drop. Asia and North America saw the largest declines, while Europe was the only region still growing. Those figures run parallel to the rise in interest rates. As money tightened, fewer unicorns emerged, almost like a mirror image of the capital cycle. It's a direct link. High capital costs choke off reckless expansion, forcing survival to matter more than spectacle. Still, unicorns haven't disappeared from the conversation. Each one that does emerge receives recognition, but with a different framing. Audiences understand that lasting under these conditions means the company likely has stronger footing, solid revenue plans, and tested resilience. People no longer wonder only who's next, but also who will survive. The mythology has shifted from firework-like ascents to marathon-like consistency. So in 2025, when we talk about unicorns, we talk about companies fewer in number, slower to appear, but more credible when they do. They're built with different assumptions. They're held to higher standards. And they embody a set of trade-offs defined by today's financial climate, not yesterday's free money bubble. What used to be considered a show of flash is now respected only when it comes with stamina and structure. Their rarity feels earned. So what actually changed? In the next section, we'll see the one number that turned the party into a wake. Low-interest party versus high-interest hangover. The contrast between the old era of easy capital and today's harsher conditions is stark. When central banks pushed rates to near zero, startups treated cash like oxygen and built entire strategies around consuming as much of it as possible. The environment made it rational, at least on paper, to accept enormous losses in pursuit of growth because tomorrow's profits were almost as valuable as today's. But as rates surged sharply higher in 2022 and 2023, that math broke down. With borrowing costs no longer trivial, the promise of far-off earnings holds far less weight than it once did. Back then, founders didn't have to convince investors that losing money was tolerable. They convinced them it was strategic. A sky-high burn rate was spun as proof of demand. $50 million lost every month could be rebranded as momentum, the sign of a future monopoly taking shape. Cheap debt ensured there would always be another round to plug the hole. So what mattered was how fast you scaled, not how efficiently you survived. Venture capitalists leaned into this logic, believing that once dominance was established, the company could always pivot to profitability later. The shift since rates crossed 4 or 5% has erased that leniency. Each dollar lost now feels more consequential because it carries a higher opportunity cost. If $20 million vanishes into subsidies this quarter, that isn't framed as ceding the ground for dominance. It looks like capital that could have been earning elsewhere, but instead went up in smoke. In a high-rate setting, optimism no longer bends the ledger. Spending must clear a much tougher hurdle, and investors see runaway losses as recklessness, not strategy. What changed most visibly is how investors themselves approach funding conversations. In the era of free money, pitch decks filled with exponential user graphs and vague promises of profit 10 years out seemed enough. Growth curves dazzled. Today, the mood has hardened. Investors open with questions on contribution margins, churn rates, and per-unit profitability. The very details once dismissed as dull are now central to whether funding moves forward. It isn't that growth has lost all appeal, but that financial discipline sits on equal footing with ambition. Put this into practice with an example. Imagine a delivery startup planning to blitzscale in 2018. It slashed prices, delivered every order at a loss, and relied on huge subsidies to drag customers in. The story was that once scale locked everyone into the platform, profits would eventually flow. Investors tolerated years of red ink because low interest rates made future returns look nearly as attractive as immediate ones. Flash forward to 2025, and that same model collapses. With rates around 5%, those subsidies translate into erosion of value. Each round of losses pushes investors further from acceptable returns. Instead of a shrewd play for market share, the old playbook now looks like setting money on fire. This isn't just about psychology, it's baked into the math of valuation. When borrowing costs are near zero, the difference between profits today and profits 10 years from now is slight. But when money is expensive, that gap widens dramatically. Put simply, when money costs more, future profits no longer justify burning cash today. The spreadsheet refuses to be flexible. Most viewers already feel this in their own lives. It's the same reason a small change in mortgage rates sends payments soaring. Tiny percentage shifts compound into major differences over time, and businesses can't ignore that arithmetic any more than households can. For startups, the fallout is visible in how funding actually flows. Mega rounds worth hundreds of millions are far harder to justify because the old exit paths look less reliable. IPO markets are cautious, private investors tighten their criteria, and fund managers raise less capital themselves. In 2021, global venture investment peaked at over $680 billion. By 2023, that figure had collapsed under $300 billion, more than halved in just 2 years. In the first half of 2025, U.S. venture funds raised only $26.6 billion across fewer than 250 funds, a steep drop that signals just how scarce fresh capital has become. The endless pipeline that once fueled blitzscaling has dried up. Without that pipeline, the model collapses mid-flight. Blitzscaling depends on raising massive rounds back-to-back before profitability arrives. If each next round is in doubt or only available at unfavorable terms, then the plan to absorb huge losses falls apart. Today, 1 out of every 4 startups that does secure more funding raises at a lower valuation than before. That kind of down round was rare during the heyday of cheap capital. Now it's common. For founders, survival depends on long runways and disciplined burn rates. Aiming for 24 to 36 months of capital on hand has replaced the old 12 to 18-month cycle. The cultural changes inside startups reflect the new discipline. Founders who once pitched visions of rewriting the world are now expected to walk through detailed spreadsheets line by line. Boards pin them down on per-unit economics, not just overall traction. Growth charts that once impressed investors now set off alarms if each user added deepens the loss column. Employees, too, feel the mood shift. Instead of lavish perks and swelling headcounts, they see hiring freezes, pared-back benefits, and leadership preoccupied with cash flow. The aura of inevitable success fades, replaced by reminders of strict budgets and limited capital reserves. The external narrative has shifted in parallel. Media coverage is more skeptical, emphasizing balance sheets and risk rather than hype. Where headlines once glorified billion-dollar rounds raised overnight, now they focus on looming layoffs, falling valuations, or battles to achieve unit profitability. Public sentiment that once idolized high-flying founders has cooled as stories of collapse accumulate. The myth-making power of blitzscaling weakens when audiences see more bankruptcies than breakthroughs. At its core, blitzscaling itself has not changed. The method is still about grabbing markets first and worrying about profits later. What changed is the surrounding system that allowed that approach to seem rational. In an environment of free capital and near-zero rates, The strategy looked aggressive, but defensible. In a high-cost environment, the numbers no longer back it up. Every loss becomes a heavier burden, every delay in profits more expensive. Without cheap and endless capital, the blitzscaling engine stalls. It's important to stress that. Ambition hasn't disappeared. Founders still dream of global footprints and category-defining businesses. What has ended is the tolerance for losses as a way to get there. Investors simply don't have the patience they once did. Patience thrived under free money, where waiting a decade for returns didn't cost much. With rates high, patience costs real dollars, and few are willing to carry that burden. For both companies and individuals, the lesson is the same. When money becomes more expensive, discipline reclaims center stage. In startups, that means efficiency and sustainability over speed and spectacle. For personal finance, it means that stretching budgets or making high-risk bets becomes far more dangerous when borrowing costs rise. The difference between a world where cash is cheap and a world where it costs 5% isn't abstract. It rewrites the basic incentives of how money is spent, whether by investors, households, or entire industries. As we've seen, the end of the low-interest party revealed the structural weakness baked into many high-growth companies. Once the math shifted, strategies that relied on endless funding rounds turned brittle. And those weaknesses didn't stay hidden. The companies that were held up as icons of blitzscaling soon became examples of its fragility, their struggles and failures illustrating exactly why the model has lost its appeal. Uber, WeWork, and the ghosts of blitzscaling past. The most visible case studies of blitzscaling come from the companies that once embodied it most fully. Uber, WeWork, and the food delivery giants were at different points held up as proof that losing billions could still be a winning strategy. Today, their stories have become mirrors reflecting the limits of that idea. Each of them rose quickly when capital was cheap, but once the conditions changed, their foundations were tested, and in some cases, they cracked. Uber's story illustrates both the promise and pitfalls of blitzscaling. The company rewrote urban transport almost overnight, spreading to hundreds of cities and reshaping how people thought about getting from place to place. It burned massive sums subsidizing low fares, recruiting drivers, and fighting regulators, all while promising investors that dominance would eventually justify the losses. Uber has historically run large deficits, but in recent years it has been working to tighten its unit economics, exiting costly side ventures, and laying off roughly a quarter of its workforce. In 2024, it reported a net profit of $9.8 billion, though that number owed much to one-time accounting adjustments rather than purely strong operating margins. Even with those qualifications, the company's shift toward prioritizing free cash flow profitability signals a recognition that its original playbook was unsustainable. For investors, the lesson is clear. Global reach and brand recognition don't erase the need to make every ride and every delivery profitable on its own terms. WeWork shows an even sharper collapse. Once privately valued at $47 billion, the company pitched itself as a revolutionary tech firm that would disrupt office real estate rather than simply sublease it. For a few years, cheap funding allowed it to expand aggressively, taking on long-term leases and transforming buildings into branded shared spaces. But the model depended entirely on endless access to capital and optimistic narratives. When investor sentiment shifted and markets began questioning its lack of profitability, the facade crumbled. By November 2024, WeWork filed for Chapter 11 bankruptcy in the US and Canada, burdened with $18.65 billion in debt against $15.06 billion in assets. The rise and fall demonstrate how scale backed by hype cannot replace sound business fundamentals. For those looking to invest in companies promising disruptive models, the warning remains blunt. Size and branding do not equal durability when debt obligations exceed supportive cash flows. Food delivery platforms illustrate yet another dimension of blitzscaling's challenges. Companies like DoorDash, Uber Eats, and others rushed into the market with deep subsidies, training customers to expect restaurant meals delivered to their doors at prices barely higher than dining in. Adoption soared because investor money covered the real cost. But behind that growth sat stubbornly high customer acquisition costs. DoorDash, for example, runs about $6 per customer, with contribution margins only gradually improving from near zero to around 10% by year 3. As subsidies tapered, backlash grew. Users pushed back on rising fees, restaurants objected to higher commissions, and drivers expressed frustration over wages and tipping practices. Even with the food delivery market projected to reach $250 billion by 2027, saturation and thinning margins make lasting profitability elusive. The sector survived, but instead of commanding the giant valuations once dreamed of, these companies now grind forward, under relentless financial pressure. The enduring point for investors is that rapid scaling in competitive markets often magnifies costs more than it accelerates profits. Taken together, these examples map the limits of blitzscaling in the real world. Uber demonstrates that even dominant market positions don't guarantee smooth paths to profitability if the unit economics remain strained. WeWork shows that hype can inflate valuations far beyond what business fundamentals can sustain, and when the funding environment turns, collapse can be swift. Food delivery platforms reveal the hidden fragility in consumer behavior. Mass adoption built on subsidies proves reversible once real costs appear. Across all three, the pattern is the same. Growth magnifies problems that discipline might otherwise solve more slowly, and once investors become skeptical, the weaknesses stand out in sharp relief. What makes these stories matter is not just the financial history, but the investor psychology they have shaped since. The spectacle of billion-dollar valuations, achieved almost overnight, has changed into cautionary tales told in pitch meetings. Uber may still operate, but it remains closely watched for whether free cash flow can finally turn from promise into routine. WeWork's collapse remains an unavoidable shorthand for reckless expansion, cited by both venture capitalists and critics whenever a company appears to build hype faster than revenue. And for delivery services, the industry struggles to balance fees, costs, and competition remind backers how difficult it is to pin durable profits onto convenience at scale. The ghosts of blitzscaling are not confined to case studies in business schools. They hang over every conversation where founders argue for losing money today to win tomorrow. There's also a cultural angle that reinforces these financial realities. Uber's early years leaned on tactics that ignored rules and brushed past local laws in order to grow faster. That worked for a while, but it also left reputational scars with regulators, drivers, and customers. WeWork wrapped its financial stress in the camouflage of inspiration and lifestyle branding, but internally the lack of governance made its eventual collapse feel less like a surprise and more like an inevitability. Delivery platforms, by treating convenience as a birthright subsidized by investors, encouraged consumer expectations that simply could not be sustained once capital dried up. In each case, choices about how to scale created vulnerabilities not only in the numbers, but in public perception. And once trust or goodwill eroded, financial pressures only deepened. For anyone navigating today's markets, these case studies contain a practical takeaway. If you're evaluating startups to invest in, or even holding equity from companies built on growth-first models, the key questions are not about user growth alone. Ask instead about contribution margins, customer acquisition costs, and the credible path to free cash flow. If those aren't in place, scale will only multiply losses rather than set the stage for profits. The consumer experience reinforces the same idea. Free or heavily discounted services may win attention quickly, but savvy audiences increasingly ask how those economics can work in the long run. In other words, growth funded purely on optimism is no longer persuasive. Because these examples remain vivid, the shadow they cast extends forward. Founders building new ventures know that investors are quicker to raise objections when they hear echoes of Uber's balance struggles, WeWork's overextended obligations, or DoorDash's customer acquisition trade-offs. Each new claim of "we'll sort out the profits later" is filtered against this recent history of disappointment. And for investors in 2025, memory of how enthusiasm can reverse into losses keeps them cautious even when presented with markets that feel hot and full of potential. That memory matters because it ties directly to what follows. Even in the face of spectacular setbacks, not every startup has abandoned the strategy. There remain founders and investors willing to gamble that today's losses can buy tomorrow's dominance, if only they can move quickly enough. The question is what kinds of businesses think that gamble is still worth it, and how they're navigating the harsher climate compared to their predecessors. Market saturation. Growth has boundaries. Growth has edges that appear sooner than many blitzscalers expected. Market saturation. Growth has boundaries captures one of the harshest lessons startup investors had to absorb. In the early years, founders assumed audiences were endless and that demand curves could stretch almost infinitely upward. That assumption offered justification for spending billions to expand at breakneck speed. Why worry about profitability if the total number of potential customers seemed limitless? Yet over time, the ceiling showed itself. Companies that spent heavily to chase new adoption found diminishing results, and entire categories matured more quickly than anticipated. Instead of being rewarded for growth, firms discovered how finite customer bases, rising competition, and exhausted consumers capped their path. Food delivery provides perhaps the clearest case study. Platforms like Uber Eats, DoorDash, and Grubhub leaned on subsidies to spark new user habits. At first, the formulas seemed bulletproof. Cities saw a surge in volumes, adoption shot upward, and investors believed they were backing the next essential utility. Industry reports at the time pegged the online food delivery market at over $100 billion worldwide, with forecasts predicting explosive expansion. But the reality didn't match the projections. Once subsidies shrank, loyalty proved weaker than imagined. The number of users willing to pay full delivery fees was smaller, and each new attempt to acquire customers cost more than before. Restaurants balked at higher commission rates, consumers resisted increased service fees, and the companies themselves carried mounting costs. Expansion began to resemble a treadmill, burning cash quickly while failing to extend reach meaningfully. Blitzscaling logic assumed endless demand, but in practice the addressable pool plateaued fast. Micromobility hit similar barriers. Scooter and bike-sharing companies rushed into cities worldwide, dropping thousands of units overnight. For a brief period, growth looked like a phenomenon. Riders logged millions of trips, and capital flooded in to fuel more aggressive deployments. Yet the limitations appeared within a few years. The frequent riders every operator counted on proved to be a narrow slice of urban populations, and casual riders seldom translated into sustained usage. Maintenance and repositioning costs ballooned. Fleets wore out faster than projections, and municipal regulations often capped usage zones. Ultimately, expansion past a certain point didn't add viable revenue. It only layered in costs. Here, too, blitzscaling sped the business past its limits. Within only a few seasons, many operators already needed to downsize to survive. Another pattern emerged in by now, pay-later platforms. These fintech tools boomed in the pandemic, promising users simpler ways to split purchases and merchants a way to raise transaction volumes. Adoption surged in the early wave, but the customer base reached a ceiling faster than expected. Once early enthusiasts had signed on, attracting the next wave meant heavy marketing spend for users who were skeptical or already served elsewhere. At the same time, competitors multiplied, slicing up the available market. Adding to the pressure, regulators began to tighten oversight, worried about consumer credit risks. Costs rose, and the model's weaknesses appeared. Blitzscaling assumed global uptake would expand without friction. Instead, the base proved finite, economics strained under higher funding costs, and valuations sagged under intensified scrutiny. Cloud kitchens, or ghost kitchens, offered another variant of the saturation story. Born to meet food delivery demand, they packed multiple virtual brands into one shared cooking facility, promising lower overhead and faster service. For a while, the expansion looked unstoppable. Venture funding poured in as operators opened facilities in dense urban zones. But soon signals of congestion emerged. Local markets filled with scores of undifferentiated brands competing for the same delivery customers. Traditional restaurants improved their own takeout operations, competing head-on with virtual kitchens. Loyalty to purely digital brands proved fragile, leaving ghost kitchen operators trapped in cycles of expensive promotions to remain visible. The total appetite for food delivery had never been infinite, but massive capital inflows had multiplied the number of brands slicing at that fixed demand. Instead of creating new opportunity, blitzscaling compressed profitability. Taken together, these cases reveal the same dynamic. Consumer demand has edges. Customers willing to pay fees beyond subsidies form a limited population. Urban density can only support a fixed number of scooters, not an infinite fleet. By now, pay later can't lure customers indefinitely once credit appetites max out. Cloud kitchens can't multiply demand, they can only divide it. Blitzscaling's speed accelerated adoption, but rather than creating new audiences, it made markets hit their ceilings faster. The result was earlier saturation, higher customer acquisition costs, and thinner margins across sectors. Two sentences define it sharply. Blitzscaling makes people adopt quickly, but that very speed pulls forward the moment saturation arrives. Rising CAC and weaker loyalty follow. For venture investors, this shift has rewritten the pitch environment. In the blitzscaling era, founders celebrated massive total addressable markets, displaying ambitious projections that assumed unconstrained growth. Cheap interest rates dulled the risk of betting on infinite adoption. In 2025, investors treat such forecasts with suspicion. They ask, how many actual users will sustain payments? Where does churn appear? Has the early phase already captured the most receptive audience? Answers shape not only investment size, but also valuation multiples. Saturation awareness has become step one of due diligence, reflecting lessons bought from a decade of inflated promises that crashed once ceilings arrived. The consequences of missing those ceilings are clear in valuations. Delivery company market caps that once soared into the tens of billions retracted when user growth flatlined. Scooters once valued at unicorn levels lost credibility as ridership targets fell short. BNPL providers saw market enthusiasm collapse in combination with regulatory attention and limited demand expansion. The trajectory was the same. When scaling slowed, the justification for large valuations evaporated, and investors reset expectations sharply lower. Overpromised markets erased themselves not gradually but suddenly. Once ceilings were recognized, repricing was abrupt and painful. The cultural shift within startups is equally significant. During the 2010s, exaggerating potential upside was seen as savvy storytelling. Founders framed themselves as global conquerors. Admitting limits was treated as weakness. By mid-decade, the reverse held true. Investors reward realistic planning grounded in evidence. A founder who states clearly that their service may top out at a fraction of the population, and pairs that with a plan for profitability at that scale, gains trust. In a market shaped by repeated examples of saturation shocks, underpromising lands as credible. That inversion speaks to a broader change in culture. Ambition is still welcome, but discipline earns lasting respect. Saturation doesn't only hit investors, it affects customers as well. In the rapid growth phase, users enjoy subsidies, discounts, and novel options. But once those incentives end, companies turn to raising prices. Customers pay more for the same service that previously felt like a bargain. Delivery apps add surcharges, scooter rides become pricier, BNPL turns less flexible, and ghost kitchens cut incentives. As consumers experience these shifts, trust erodes. That erosion is itself a saturation symptom. What was once attractive becomes questionable value. And as users disengage, further spending to reacquire them grows unsustainable. A paradox sits at the center of blitzscaling and saturation. Speed does not help delay limits, it accelerates them. Expanding too rapidly compresses years of adoption into a short burst. By racing ahead, firms meet their ceilings earlier than if they had paced growth. That creates the illusion of victory followed by disappointment. Sudden stalling, rising CAC, disillusioned investors, and restless customers. Simple phrasing captures it. Blitzscaling maximizes the front end, but erases the runway. Instead of securing longevity, it burns the market early. Perspective from steadier companies reinforces this. Traditional firms expanding at measured rates often avoid early collapse. They adapt once penetration tops out by refining efficiency or improving margins. Blitzscalers, by contrast, treat limits as irrelevant until those limits crush them. Debt obligations stack high, valuations peak on unsustainable expectations, and consumer fatigue sets in. The slow but steady paths may lack flashy growth, yet they navigate ceilings without catastrophic collapse. That realization marks a cultural adjustment across investors who now look more closely for boring but durable models. Sectors that today promise boundlessness are not immune. AI infrastructure is described as touching all computing, and green tech manufacturing as reshaping all energy. The scale of those claims echoes past overestimations. Limits may come from chip supply, regulatory frameworks, or consumer adoption speed. The lesson from food delivery, scooters, and BNPL is not that growth ends everywhere quickly. but that ceilings exist always, and recognizing them early determines survival. What appears limitless today may reveal edges sooner than expected. For anyone considering investments, the lesson is practical. If you see an industry dominated by repeated price hikes and sharply increasing acquisition costs, treat it as a saturation signal. That's a red flag against assuming infinite upside. When markets mature, every extra dollar spent may produce weaker returns, an arithmetic that should shape choices both for institutional funds and individual portfolios. Every case shows that blitzscaling thrives only as long as audiences appear inexhaustible. When speed pulls saturation closer, the strategy flips from tool to trap. That turning point explains why entire categories, once crowned as future monopolies, now look fragmented or overextended. In today's high-cost, high-scrutiny environment, the margin for mistaking growth potential has narrowed. Recognizing constraints is no longer optional. And yet, not all stories ended in retreat. A handful of companies that blitzscaled through those same risks managed to pivot in time. They didn't escape limits. They adapted before investor patience vanished. Instead of burning until collapse, they found a way to shift gears into durability. Those exceptions help explain not only why blitzscaling became popular, but also what remains of it in the present. Why some blitzscalers actually succeeded. Some companies did manage to escape the fate that trapped most blitzscalers. A handful used the same breakneck tactics, but then made a crucial pivot, shifting from speed to stability before investor patience and capital dried up. Their success didn't come from staying in hypergrowth forever. It came from timing the switch to sustainable economics early enough, often by building profitable verticals or adapting the model when core growth began flattening out. A simple pattern emerges here. The winners used blitzscaling to achieve reach, but they pulled back to focus on profitability before the runway ended. Amazon remains the most famous example. In its first decade, it burned through cash to dominate e-commerce, posting 9 years of losses while pouring resources into warehouses, logistics, and technology platforms. At that time, investors tolerated the model because the potential market size appeared limitless. The difference was what came next. Amazon added higher-margin business lines that shifted the company's economics. Amazon Prime introduced recurring subscription revenue, while Amazon Web Services became a cloud division generating far greater profits than retail ever could. Today, AWS continues to act as a stabilizer. It's a high-margin arm that funds volatility elsewhere in the company. This diversification meant the company could survive long years of thin or negative profits from retail because investors saw a credible path toward high returns. The lesson is not that blitzscaling worked forever, but that Amazon switched gears by adding complementary models before its margins collapsed. Airbnb's trajectory took a different path, but reached the same principle. Its growth hinged on network effects. The more hosts joined, the more attractive it was to guests, which in turn pulled in more hosts. These compounding effects gave Airbnb defensibility that subsidies alone could never buy. Yet the turning point was its adaptability. During the pandemic, when its travel business evaporated, Airbnb pivoted quickly into longer-term stays and remote work housing. That responsiveness preserved revenue while competitors struggled. Later, the company proved disciplined by redefining how it managed fees, safety policies, and regulatory compliance. These moves reset investor trust and allowed it to navigate an IPO despite ongoing challenges. Blitzscaling gave Airbnb scale, but its willingness to change models when circumstances shifted is what kept it alive long enough to grow durable. Fintech firms illustrate the same principle in another sector. Early leaders in digital payments and online lending leaned into aggressive adoption tactics, but also proved quicker than peers in attaching profitable add-on products. Digital wallets grew into ecosystems, incorporating credit lines, insurance, and financial services with better margins. As customer bases reached critical mass, platforms became harder to dislodge, and recurring transaction revenue acted as ballast. Unlike food delivery companies that could not escape costly subsidies, fintechs turned usage into services that sustained profitability. Their blitzscaling phase was short and aggressive, followed by measured consolidation and monetization. If all three stories, Amazon, Airbnb, and fintech leaders, sound similar, it's because they are. Each used scale aggressively to establish reach, but each shifted before scale itself became a liability. The common denominator is not endless expansion. It is the willingness to adjust strategy and embrace a new stage of business before outside forces imposed it. That's where timing proved decisive. Missing that moment meant collapse or stagnation. WeWork never diversified. Its debt avalanche dwarfed its income potential. Food delivery companies never found high margin. Side businesses. Once subsidies disappeared, customer loyalty evaporated. Uber is still in transition, but even after years of global reach, its struggle lies in proving solid cash flows without adding late-risk ventures like AWS. Speed gave all these firms attention, but only those that showed investors a convincing path to profit-secured permanence. The mechanism underpinning success is straightforward. Use blitzscaling to win reach, then pivot early to ensure those customers or assets produce surpluses rather than deficits. Sometimes this means launching a new vertical, as Amazon did with AWS. Sometimes it means exploiting network effects, as Airbnb did with hosts and guests reinforcing loyalty. Sometimes it means bundling services around users, as fintechs have shown. What it does not mean is holding on to perpetual losses under the assumption that dominance justifies them. Investors eventually lose patience. Survival belongs to those who demonstrate, before capital runs out, that each marginal user can add more value than they consume. This distinction reframes blitzscaling altogether. It's not a permanent playbook, but a transient stage, one meant to accelerate adoption under abundant funding while setting up a later pivot. If companies treat it as an end state, the math ensures collapse follows. If they treat it as a launch pad, carefully timed, it can create the customer base or infrastructure needed for profitable ventures to take root. Amazon, Airbnb, and select fintech players illustrate that outcome. Their stories confirm the rule. Speed must eventually give way to discipline, or discipline will be imposed from outside. The contrast with failure cases sharpens the lesson. Uber built enormous scale, but still chases free cash flow stability years later. Evidence of how prolonged blitzscaling without a decisive pivot can stretch credibility. WeWork embodies the danger of ignoring limits until the structure caves in outright. Delivery companies assumed subsidies would convert into pricing power, only to watch regulatory ceilings and consumer fatigue collapse their margins. In each, the missing ingredient was timing. No side business arrived soon enough. No profitable adjustment arrived before debts ballooned. No pivot allowed the company to escape the trap of scale unsupported by margin. The difference between survivors and failures lies in the decision to change gears early, not late. For investors and savers, the instruction is clear. Don't be blinded by speed alone. Look for companies signaling a credible move from growth first to profitability next. Amazon's investors endured long losses, but saw the structure of AWS emerge. Airbnb revealed elasticity in its model during the pandemic and created defensible trust mechanisms that settled skeptics. Fintech players demonstrated long-term credibility by layering services with positive unit economics. These signals shaped patience. Capital will tolerate losses if the map to profitability materializes before the road runs out. The cases are limited but telling. Very few blitzscalers grew into durable giants, and those that did only survived by refusing to treat hypergrowth as endless. They pressed brakes when required and built sturdier segments to underpin future expansion. That doesn't mean blitzscaling works as a full model. It means it can, under unique conditions, act as a temporary strategy to secure reach, if and only if leadership understands when to stop sprinting. That's where a deeper lesson comes forward. Underneath all the success stories is a principle that applies outside startups too. Ambition alone doesn't secure a future. Endurance comes when growth is matched by sustainability, when speed is harnessed before it causes collapse. Investors in 2025 have absorbed this lesson, which is why they now demand profitability plans early and assess the credibility of pivots rather than chasing empty scale. The record is conclusive. Blitzscaling produces headlines, but profitable pivots produce companies that endure. And that principle isn't confined to tech giants. It offers a useful mirror for anyone managing money in a high-interest environment, where chasing expansion for its own sake can quickly turn into risk. Success in those terms isn't about who runs fastest. It's about who knows when to slow down, stabilize, and build something that can last beyond the sprint. What blitzscaling teaches us about personal finance. Blitzscaling isn't only a lesson about companies. It points directly to the financial choices households make every day. The same logic that drove founders to chase scale at any cost often tempts individuals to spend freely in the present, under the belief that tomorrow's income, raises, or investment gains will cover today's bills. What looked bold in the boardroom has its parallel in living rooms. Stretching credit, chasing risky bets, and assuming growth will always outpace costs. When conditions shift, when borrowing costs rise, when debts compound faster than paychecks, the math stops cooperating. That is where the link between Silicon Valley and household balance sheets becomes clear. An overspending household often resembles a blitzscaler fueled on borrowed money. Credit cards become venture capital, except with double-digit compounding costs. The reasoning feels attractive. Carry more debt today, and assume your higher-paid job or future windfall will make it manageable later. For years of low interest, that gamble almost felt sustainable. But with high rates, the numbers turn against you much faster. Debt, as financial writers put it, pulls tomorrow's dollars into today's spending. When rates rise, that time travel becomes expensive. What felt like momentum quickly becomes a drag. It's tempting to assume tomorrow fixes everything, but the math rarely cooperates. This is the household version of what sank many blitzscalers. Companies depended on cheap capital to survive long burn cycles, just as households leaned on cheap credit. When that advantage disappeared, firms with weak margins collapsed, and families with heavy balances faced rising interest charges that consumed paychecks. The principle is the same. Optimism on its own doesn't cover the gap. At some point, what flows out must be less than what comes in, or the structure falls apart. Looking at how businesses survived offers helpful guidance. Amazon used its early reach to launch profitable products like AWS. Airbnb innovated around its core offering, then tightened its model under regulation. At home, that survival strategy means matching ambition with adjustments. Maybe you bought a house or car when lending was cheap. Staying stable now means cutting back non-essentials, building reserves, or shifting into investments that weather higher rates. It's not a retreat from ambition, it's a pivot to preserve endurance. By contrast, households that keep spending as if credit lines are infinite start to mirror WeWork, which scaled until the doors shut from too much debt. Risky investing carries the same temptation. Individuals gamble on high-flyer assets in the hope of overnight wins, treating them like startups funding losses for eventual dominance. Crypto tokens, over-leveraged stocks, or speculative projects all come with this danger. When conditions tighten, those bets unravel faster than expected. Here the analogy is clean. If your portfolio relies entirely on hope, you are subsidizing risky growth in the same way MoviePass subsidized movies. Attractive in the short term, but unsustainable without a plan to balance the books. The counter is not to abandon ambition, but to place it alongside a solid base. Balance speculative assets with safer holdings, so one wrong bet doesn't pull the entire account down. MoviePass itself shows how personal finance can stumble into corporate mistakes. The company offered unlimited movie tickets at a flat rate, burning cash to expand fast. It bet that advertising and data would eventually pay the bills. They didn't. Losses ballooned and bankruptcy arrived. A household spending far more than it earns under the belief that a raise is coming, or the market will turn, follows the same script. Without a credible path to cover shortfalls, collapse comes before stability has a chance. The shift in interest rates magnifies all of this. In the 2010s, companies blitzscaled, and families financed lifestyles without fear that debt costs would crush them. Cheap debt muted the consequences of overextension. In 2025, the cost of capital touches everyone. A 5% mortgage rate doubles monthly payments compared to 3%. A credit card at 20+% punishes every balance carried forward. The message is identical at both scales. Capital efficiency is survival. Overspending in a high-rate climate compounds dangers far faster. You can even see the cultural echoes. In cheap money times, bold consumption looked impressive. Big homes, luxury cars, adventurous investments. In the startup world, raising colossal rounds was celebrated. But now, restraint commands respect. A family that pays down debt and keeps cash on hand looks far smarter than one that flashes upgrades financed at high rates. In the corporate arena, investors reward profitability slides, not just growth curves. The narrative of strength has flipped. Appearances now follow sustainability, not spectacle. Liquidity is another shared lesson. For startups, it meant whether investors would keep funding losses. For For households, it means whether incomes can meet obligations and whether lenders keep extending credit. That liquidity can vanish in a single quarter. Investors stop funding, banks cut credit lines. Startups fell when the capital stream dried up. Households too can slip when refinancing evaporates or credit ceilings tighten. Planning around constant access to liquidity is dangerous. Ensuring that daily cash flow works, even without new borrowing, is far more reliable. Growth itself can mask problems. Startups dazzled investors with climbing users, but hid worsening losses. Households get a raise or bonus and stretch spending with equal speed, convincing themselves the budget is strong. But if every new dollar earned is immediately spent, the imbalance stays untouched. Rising income matters only if it leaves room for savings. Blitzscaling firms collapsed when they mistook revenue for profit. Families collapse when they mistake higher salary for guaranteed stability, while debts mount quietly beneath. All of this doesn't mean avoiding ambition. It means shaping ambition within sustainable math. In corporate language, that means proving positive unit economics. In households, it means ensuring expenses don't outpace inflows. Budgets become the personal version of contribution margins. When dollars in exceed dollars out reliably, whatever remains can fund growth, whether in investments, education, or opportunity. When dollars out always exceed dollars in, the story stays brittle no matter how good it looks from the outside. For households, the message can be distilled into 3 practical rules. First, keep an emergency runway. Just as companies secure 24 months of capital to survive downturns, families need savings that cover several months of expenses, cash that buys time when income slows or costs spike. Second, avoid high-interest debt that compounds faster than returns. Debt is useful only when managed. When borrowing costs run above the returns you earn, every month makes you poorer. Third, direct investments toward assets with clear unit economics. That means choices where the risk-to-reward balance is visible and rational. Stable index funds or cash-flowing assets, not promises reliant on endless optimism. These rules create resilience. Just like investors lost patience with startups burning money endlessly, creditors lose patience with borrowers who never control spend. And just as the companies that survived were those with clearer economics, the households that survive are those monitoring obligations honestly. Growth is allowed, but only if it builds more safety than it erodes. The temptation to chase hypergrowth will never vanish. It looks good to sprint ahead, to spend today and believe that the future is always larger. Startups in 2018 fell for that logic. So do many households staring at credit lines in 2025. The results, however, are documented clearly. The risk compounds until correction arrives. Some survive long enough to pivot. Many don't. Recognizing limits and building sustainability isn't the opposite of ambition. It's what keeps ambition intact under pressure. The bigger lesson is straightforward. Blitzscaling revealed how fragile overextension really is. Whether in a boardroom or a kitchen table, tomorrow's hopes cannot finance today's deficits forever. Winning in a costly capital environment means managing ambition within structure, pacing growth, keeping debt purposeful, and making sure the numbers tie back quickly to stability. That pivot is what kept Amazon and Airbnb alive, and it's the same discipline that protects households facing high-interest debt. These lessons matter because the financial climate won't revert soon. We're still living in an environment where borrowing carries weight. For startups, it changes how they raise money. For individuals, it changes how they borrow, spend, and save. The real question is no longer whether growth is good. It's what kind of growth still works under today's rules. And the answer, to both companies and households, lies in models that respect costs, embrace discipline, and build durability. As the decade continues, attention naturally shifts outward. If blitzscaling defined the last 20 years of startup culture, its limits shape what comes next. Growth doesn't disappear, but the way we pursue it is already different. And that new pace, forged under higher borrowing costs, will set the pattern for the next generation of winners. The future of growth in a higher interest world. Looking ahead, the future of growth in a higher interest world looks very different from the years when capital was cheap and mistakes were forgiven. High rates make cash burn unattractive, so newer models lean towards steadier expansion, leaner budgets, and stricter regulatory compliance. Success now comes from mixing innovation with financial discipline, proving revenue sooner, and keeping customers without relying on subsidies. Industries like AI and climate tech still offer huge potential, but only when approached with a plan that balances ambition against risk. For viewers, there are 3 takeaways worth applying personally. Cheap capital created blitzscaling. Higher rates, regulation, and market saturation exposed its flaws. And today, unit economics plus compliance matter more than ever. Treat these as principles when evaluating investments or your own financial decisions. If this helped you rethink how to judge high-growth companies, like and subscribe for more explainers on investing and protecting your money.